Good morning and welcome back to another Money Not Math conversation. Today's conversation is there light at the end of the inflation tunnel? All right, it is Thursday, June 16th. And as we all know, inflation affects us all differently, but it definitely affects us all, unless you have so much money that it doesn't really matter to you. And that's also possible. And if that's the case, congratulations. However, I feel like for the most part, even if it's a little bit, inflation still affects us all, some more than others, of course. So I'd like to have a conversation today about how it affects us, right? Not only does it affect us on our spending habits, our travel habits, our gifting habits, our leisurely activities. It's really interesting to see how different people make different buying and selling decisions. For example, I just sold my car today for more than what it was quoted for last year, because it's direct correlation to supply and demand of one in the automobile world. The supply is way down, but the demand is where it's always been for the most part. And two, my car gets great gas mileage. What do we know about gas prices? They've skyrocketed, right? So it's really fascinating how inflation actually sort of helped me there. But in pretty much every other phase of my life, it's costing me money because, well, everything's more expensive. So it's really a fascinating thing. And then we have what's called shrinkflation, right? So inflation is the very simple thing of this pen used to be $1. Now, inflation in the last 12 months has been like 8.6% for the CPI. This now would be $1.08 or $1.09. Whereas shrinkflation is, for those who haven't heard that term, is when the company sells you the same pen, but maybe they made it shorter. Or the easy example is they sell you a bag of potato chips with less chips in it. Or if you look at an old jar of peanut butter from like 30 years ago, it's significantly larger than a jar of peanut butter today. And that's the company's way of making you think you're not spending that much more, but really they're selling you less for either the same or a higher price. So it's just some things to think about there. And with that, I wanted to reference a news article that I got from Dimensional, and it's written by Wes Krill, a PhD, head of investment strategist and vice president at Dimensional. And I think this is an extremely helpful piece that I will be emailing out to all my clients, but I'll also take some screenshots so you can look at the pictures. If you're not it's a little easier to read it rather than listen to me talk about it. If you're listening to the podcast, then I'd encourage you to go over to my Facebook or Instagram page if you'd like to, or my business page if you'd like to read the article. Otherwise, I will be reading it to you. So like Wes Krill says, light at the end of the inflation tunnel. At some point over the past year, the financial media's inflation coverage transitioned from will this high inflation persist to here's how to cope with inflation that's here to stay. So I'll say that again. The media has changed from will this high inflation persist to here's how to cope with inflation that's here to stay. It seems some investors have resigned themselves to a new normal of high inflation following decades of below average consumer price changes. However, financial market data tells us a different story, one of potentially softening inflation. Break-even inflation, BEI, rates offer a window into markets' inflation expectations, defined as the difference between yields on nominal and inflation-protected bonds of the same maturity. BEI, break-even inflation, represents the inflation rate at which investors would be indifferent between the two. If actual inflation were to exceed break-even inflation rates, investors would be better off with the inflation-protected bond. If inflation were less than the break-even inflation, the reverse would be true. So investors would not be better off with the inflation-protected bond. Break-even inflation is therefore commonly interpreted as the average annual inflation rate expected over a given time horizon. The 1-year break-even inflation shows a spike in inflation expectations this year following increasingly high consumer price index changes, CPI. But the trajectory appears to have changed course over the past couple of months. See Exhibit 1, which again, if you're on the podcast, I'm sorry you can't see this, since peaking at 6.3% in late March. The 1-year, the break-even inflation had fallen to 5.2% as of June 10th. This might be the market's way of telling us it sees inflation getting under control in the near future. Let's hope that's right? We don't want to see inflation keep going up. It'd be nice for it to start going down a little bit. With that, we're looking at the exhibit here, and I know you can't see this, but like I said, I'll post pictures. So I'm not going to spend too much time on that. In case if you really are into the numbers, you can investigate that more on your own, or reach out to me and I'm more than happy to have a conversation with you about it. Back to the article, it is important to remember that realized inflation can diverge from expectations. For example, the 1-year break-even inflation rate as of May 3rd, 2021 was just 2.7%. Over the next 12 months, the consumer price index grew by 8.3%. Pretty big miss, meaning a substantial portion of this inflation seemed to have been unexpected by the market. From January 2007 to April 2022, the difference between actual inflation and the predicted by break-even inflation varied from negative 5.59 to positive 8.43 percentage points. So that's a really another important reminder to us, whether it's the break-even inflation rate, whether it's the consumer price index, whether it's the stock market itself. Just because we expect something to happen, it doesn't mean it actually will. Just because the models predict something to happen, it doesn't mean it actually will. So it's really important when you're building the overall retirement plan to plan for what you want to happen, but also prepare for what can happen. So continuing with the article, while nominal, i.e. not inflation protected, bond prices reflect expected inflation. Investors who opt for Treasury inflation protected securities or approaches that overlay inflation swaps, real return bond strategies, get compensated for actual inflation. Investors who want to reduce uncertainty in the event of higher than expected inflation may benefit from these inflation hedging approaches. So that's the primary part of the article. The rest is just disclaimers that, like I said, I'll include. But the main thing is there light at the end of the inflation tunnel, right? According to the break-even inflation rate with bonds, inflation is expected to start going down over the next 12 months rather than going up. So that's a hopeful win. Thank you so much for your time and joining me in today's Money Not Math conversation. Please let me know what you think by commenting on this post and letting me know, 1, if you have questions about this conversation, 2, what you thought about the conversation, and 3, please comment with any requests for future Money Not Math conversations. Thank you so much for your time and I hope you have a great day. Bye.